The Ateneo Alumni Association has evolved from its image of a boys' club in the early years to the image of an active alumni association of men and women for others.
I think it's very important to remember that the Ally performs a very important education value. The education of our graduates ends not with graduation, but with their continuing practice in introduction into the legal world.
This is a big task, but I believe everything is possible as long as you believe in our dear Lord. And as Atenean lawyers, we do believe. And with your help, we will be able to do it. Let us continue to be men and women for others. Join the Ally.
Join us!
Join us.
Join us.
Good afternoon to everyone, Ateneans, heads of industries, CFOs, COOs, CEOs, and lawyers, and those like me who are just interested to learn from Attorney Refran or Roel to the chairman of our board, Teddy Cruz, our president, Nena Rosales, and the members of the board. We greet you good afternoon. The title of this afternoon's webinar is Game Changers in Capital Markets, REITs, 101, and FinTech. I am deeply honored to introduce a colleague in the profession, an Atenean, Roel A. Refran. He is the Chief Operating Officer of the Philippine Stock Exchange, where he leads the regulatory and operational transformation of PSE towards its vision of becoming a premier exchange with world-class standards. He started his career at CSIP Salazar Hernandez in Datmaitan before joining public service as Chief of Staff of Senator Ralph Recto, Chair of the Senate Ways and Means Committee. He had a brief stint at ACRA before his appointment as General Counsel of PSE. Roel is a member of the Commercial Law Department of the Philippine Judicial Academy and a Professorial Lecturer 1 in the PhilJA Corps of Professors. He chaired the Capital Markets Development Committee of the Philippine Chamber of Commerce, an industry dedicated to enhancing the competitiveness and development of the capital markets through advocacy and investor education programs. He was a past president and chairman of the Philippine Fulbright Scholars Association. Roel combines academic theory with actual professional experience and regulatory perspectives in the capital markets in his teaching engagements. He is a professor of law at the Ateneo Law School, where he teaches commercial law review, securities regulation, sales, negotiable instruments law, and special topics in commercial law. He lectures in the MCLE and bar review programs of the same school. Roel also teaches finance courses in graduate business schools as a professorial lecturer at the University of the Philippines, Verata School of Business, for its Master of Science in Finance program. Roel designed and teaches a course on fixed income market analysis and strategies at the Asian Institute of Management, where he is an adjunct faculty. Roel holds an MBA with concentrations in capital markets, alternative investments, and finance from Emory University's Giuseppe Business School in the USA, where he was a Fulbright scholar. While at the Emory University, Roel worked as an associate at the Emory Center for Alternative Investments, where he was immersed in various policy, commercial, and legal issues relevant to private equity, hedge funds, venture capital, real estate, and art. He attended courses in the Emory University School of Law and took up securities regulation under the esteemed Professor William J. Carney. In 2012, he was inducted lifetime member of Beta Gamma Sigma, the International Honor Society that recognizes outstanding students in business. He received a Bachelor's of Science in Business Administration and Accountancy degree, magna cum laude in 1995 from the University of the Philippines, and Juris Doctor degree, second honors from the Ateneo Law School in 1999. You will be happy to note that in the May 1995 CPA licensure examinations, he garnered the 18th highest rank among the successful examinees. Roel also placed 4th highest in the 1999 National Bar Examinations, which registered the lowest national passing rate, 16.59, in the history of the bar exams. Before this, I thought that it was 17%. There was something lower than 17%, and it was his bar examinations where he ranked number 4. In 2014, the University of the Philippines Verata School of Business conferred on Roel the Distinguished Alumni Award. A staunch advocate of exercise and fitness, Roel is a 2-division bronze medalist in the 2002 and 2004 Mr. Philippines National Bodybuilding competitions. Let us welcome, and I'm really deeply honored to introduce to you today, this afternoon, Attorney Roel Refran.
Thank you very much, Attorney Tranquil, for the kind introductions. And it's really a pleasure, to be here. And big thanks as well to the chairman of ALAI, Attorney Teddy Cruz, as well as the president, Attorney Nena Rosales. It's a big honor for me to be able to connect not just with the alumni of Ateneo, but I understand as well even to the public via Facebook Live.
And we are very glad to have you. We are not only glad, but we are deeply honored. So here's now the floor for you, Attorney Refran.
Thank you. Pleasure is all mine. Thank you very much. Magandang hapon, host, to everyone. I hope everyone is well. And the subject matter that we will be discussing for this afternoon is what is called a real estate investment trust. And it technically is what I would call a game changer in a lot of ways. And I'll walk through the very concept, the core concepts behind an REIT, and why there's a myriad of regulatory requirements, because there are as well a lot of benefits that are given both to the issuer corporation, the real estate company structured as an REIT, as well as to the investing public, whether you are an institutional investor, like, for example, let's say GSIS, SSS, or the big banks, or you are an ordinary retail investor in the Philippines or even the OFW, Filipinos working abroad. And then at the tail end of our presentation this afternoon, I thought I'd also share very interesting updates and developments in what I would say a very dynamic FinTech space. When you look at law, I always look at law as a convergence with other disciplines. And in my part of the world, the financial and capital markets, the intersection of law with what's happening around us, when you talk about cryptocurrencies, when you talk about virtual currency exchanges and all that, I think it's important for us lawyers, as well as management people, to understand what are the considerations as well as the principles that we should properly appreciate before we even consider partaking in these instruments. So I would now ask Anvic to please share our screen for the presentation for this afternoon. So this is the E-Lecture Series of Father Joaquin Bernas S.J. I believe this is the 9th E-Lecture Series. So our title is really Game Changers and Capital Markets, REITs 101 and FinTech. So I'm assuming some may have already a good understanding of REITs. Some may probably have heard of it or read about it. But I believe we can adjust and we can probably walk through the basics as well as address any questions you may have on the finer points of REITs. Okay, next slide, please. So I have 4 items that I thought we can cover for this afternoon. What's the basic principles behind an REIT or REITs? What are the benefits of listing an REIT for availability or for offering to the investing public? And then item number 3 would then go to the regulatory framework of REITs. And finally, FinTech developments as they relate to the legal profession. Next slide, please. This is a question that probably a lot of people have been asking. What's so special about REITs? Why is it so popular? And when you read the business pages today, you see there's a lot of big real estate companies who are either preparing for an REIT initial public offering, or who are already probably in the advanced stages and are already conducting their marketing activities as and when they already prepare for their REIT IPO. Okay, so why is there a REIT mania today? And you would see in the next slide, for example, this is a bird's overview, okay, a step back on how the Philippine stock market is performing in the time of COVID. Okay, now the Philippine stock market is measured primarily through what is called our PSEI. When you hear PSEI, used to be called PComp or Physics. This is the basket of 30 of the most liquid, highly tradable, as well as widely held companies listed in the PSE. And you would see in this graph that the trend has been, kind of volatile. It has been going up and down for the past year or so. We had our all-time highs 3 years ago, back in January of 2018. And would you believe that we were actually trading the PSEI at 9,058 levels? And through the years, what we have seen is it has gone up and down to its present levels of 6,000. Actually, today we ended the market at 6,496 points, which is compared to the ending levels of 2020, we're still down roughly 9% year to date, beginning January up to the current date. Okay, so I think you always would compare when you look at investment opportunities, you always compare to the benchmark. If you talk to your financial advisors to go to a bank, they'd probably offer you mutual funds. They will offer you unit investment trust funds or UATF, whether it's passively managed or probably you'd act for active management. But really, the market is measured by way of the benchmark, the PSEI. And that's something that we will always have at the back of our mind as we compare and contrast different investment opportunities. In the next slide, you would see capital raising activities, despite the pandemic, have been pretty robust and pretty active. In fact, we had the biggest initial public offering by way of the Mondenisin Corporation IPO. And this is the Lucky Me Skyflakes, very, very global company. Would you believe this is actually in a Filipino company? And we also have a couple other fundraising opportunities by our listed companies. You have their Ayala Corporation Energy, ASEN, leading the way with respect to the green-led recovery, as I call it, renewable energy, as well as Cebu Pacific conducting what's called a stock rights offering to their existing shareholders for fundraising purposes. As you know, the airline industry has been badly hit by the pandemic. And the Double Dragon MP REIT is the second REIT that listed in the PSE. The first one was the Ayala REIT or A-REIT, which listed back in August of last year. And Double Dragon REIT listed March of this year. So a lot of activities happening during the pandemic. Now you might say, well, there's a lot of risk aversion on the one hand, but on the other, there's also opportunity takers. They see that the market right now is looking for good deals. And there's a lot of what I call dry powder, uninvested capital, whether by the retail investor or as well by the institutional investor. So this is a good opportunity as well for corporates, either to do a primary offering via an initial public offering or go back to the market if they are already listed via what's called a follow-on offering. And in the next slide, you will also see the pipeline. And probably you would see familiar names. You have Philinvest REIT, whose offer is actually ongoing as we speak. You also have Del Monte, which would also conduct an IPO, initial public offering. And you have another REIT, Robinson's Land Commercial REIT. And you look to the right side of the screen as well, you have Mega World REIT, MREIT, okay? Now, in the news, you would see others who are preparing for an REIT IPO. Vista Land and Landscapes. You also have Jollibee Double Dragon Industrial REIT, okay? And, well, it's not yet there, but I'm pretty sure SM is also the biggest mall operator, is definitely preparing as well for their REIT. Okay, so a lot of REIT listings are in the offing. Of course, at the backdrop is an economy that's still reeling from the pandemic. You know, last year our economy contracted by 9.5%, but for this year, economists are saying that given the base effect, the low base effect, the economy of the Philippines would probably grow by 5%. At least that's a target of our economic managers. So in the next slide, please. Now, let's do a check of real estate companies, right, versus the property index. We do have what's called the property sector index. This is a subsector compared to the PSEI, which is the main benchmark index. Now, what I'm showing in this slide is, if you look at AREIT, that's A-REIT, Ayala REIT. Okay, Ayala REIT went public via an IPO in August of last year. Their properties are in Makati. I think the one is beside Makati Medical. which is the Ayala North Exchange. Another one is what's called Solaris. And another one is at the corner of Ayala and McKinley. All right. Now, what do you notice? A-REIT, I track the returns. Okay. The returns here pertain to total returns. Okay. When you talk about total returns, you are referring to two components. The first component is the dividend yield. The dividend yield is dividends per share divided by the market price, and that will give you the dividend yield. And the second component of total return is the capital appreciation, okay? The market price of the common share over time. And probably see that A-REIT has outperformed. Look at the graph. A-REIT is outperforming the PSEI, the blue line. A-REIT is outperforming as well the property sector, the dark blue line. And you would see as well Double Dragon, which is another real estate investment trust, at the bottom of the slide. Okay, so when A-REIT went public, its IPO price was at 27 pesos, right? And I think as we speak, it's now doing around 34, 35 pesos, right? So that's a very impressive uptick in terms of the base stock price. And normally in an REIT, the reason why you would expect capital appreciation is because there would be infusion of additional real estate assets into the REIT vehicle. Therefore, you look at the valuation of the company, necessarily it would add up to a more valuable company so that your market price would necessarily as well follow and increase. Okay, so very interesting. You look at A-REIT being an REIT, outperforming even the market, outperforming as well the property sector, outperforming also its peers in the market. Next slide, please. And this is just a further itemization of the comparison between REITs and other property stocks. I just selected those which probably are most familiar to our audience. So you have in the yellow highlighted portions, those are our listed REIT. So far, we only have two. That's Ayala REIT and Double Dragon MPR. And the others in the particular rows, for example, for the left side of the graph, or of the table rather, you would see property companies such as Philinvest, Robinson's Land, Vista Land, Mega World, Ayala Land, and Double Dragon. So you see the dividend yield, obviously, while you would see, for example, Philinvest giving a 7% dividend yield. Wow, that's very attractive. A-REIT is giving around 4.8% dividend yield, okay? Now, REITs versus other indices, we have 6 sectoral indices in addition to our benchmark index. You'd see that at the top of the table, the mining and oil sectoral index is giving us a dividend yield of 5%. And A-REIT is giving 4% compared to, for example, Double Dragon's 2%. Okay? Remember, when there's a crisis, investors go to safe haven assets, right? The closer you are to cash, all the better, because cash is probably going to be the safest assets during a pandemic or during crisis. But nevertheless, there are a lot of investment mandates given to corporates that they need to invest those cash. Otherwise, it would be wasting assets. And so the economic conditions now would probably encourage yield-seeking investors to flock to REITs. And I say investors, I'm just not referring to retail investors, but as well institutional investors, retirement funds, insurance companies, because of the features and benefits or advantages of REITs that we will go to in the next few slides. Next, please. So let's try to answer this. Why is there a REIT mania today? Okay. Well, number one, as we have seen in the previous slides, REIT shares, okay, REIT common shares, the market price, and when we track them over time, the growth outperformed. Okay, in short, is what I call the alpha, right? If you just track the market performance, then you're just getting the beta. But anytime you are performing higher than market in terms of returns, in terms of growth, in terms of total return, most especially, you're actually an outperformer. You're outperforming other asset classes during the pandemic. And I'm not even referring, for example, to common shares, to fixed income instruments. As we know, we are in a very low interest rate environment. So even if you look at government securities, probably the 10 years, based on the auctions by the Bureau of the Treasury, probably yield around 4%. and the 1 years would yield between 1.3 to 1.5%, right? So look at inflation targets of the Banco Central. They're targeting 4.1% for the year. Then probably you will have second thoughts when you consider those other asset classes. Okay. Second point, why is there a REIT mania today? The performance of PSE listed REITs, as we have seen, we so far have seen the two PSE listed REITs. They do provide for better returns in terms of the stock price compared to the other sectors, as well as the benchmark. Okay. The third bullet point highlights a core concept of REITs. I think early on we have to understand that REITs are structured as shares of stock. Okay. Shares of stock, normally in an ordinary corporation, the returns that an investor of a corporation would expect from being a part owner, because you are a shareholder, would probably center on the dividends, right? Except that those dividends will have to be first declared for distribution by the board of directors, right? And there would probably be a lot of occasion or reasons in a pandemic for the board of directors to look at the long-term sustainability. In fact, last year, we did have a couple of our listed companies defer their cash dividend declarations or even distributions because they would rather hold on to scarce cash, scarce resources in the time of pandemic, right? So does that work for an REIT? Is that the same mentality for the REIT management? Or are there requirements under the law for them to declare dividends? So I'm referring to the third bullet point. Unlike fixed income instruments, which would only yield interest income, right? Although we are in a low interest rate environment, globally, REIT securities provide two income streams to the investor: dividend income and potential capital gains. Okay, now that's on the investor side. What about the issuer? The best benefit to the issuer is really to unlock the potential of an otherwise, I would say, undervalued asset if you subsume it within another vehicle, which is not a REIT structure. All right. It could also be a motivation for the founders who would like to go public via an REIT IPO to be able to get a good valuation and to have the liquidity benefits of a listed security. All right. So that's on the part of the issuers, other than the benefits to the investors. Okay. The last bullet point in this slide would show rather that the benefits of listed REITs would always have to be compared to the other alternative, right? Why don't you just buy the hard assets? Why don't you just invest in actual real estate? And you probably have seen that those two assets have their pros and their cons when it comes to holding on to hard assets versus liquid securities. Okay. First off is really a listed security is very liquid, right? When I say liquid, there are two ways to determine liquidity. The first way is that when I want to exit, I can exit in a short amount of time, right? That's the time liquidity factor. And second, when I want to exit at a given price, I have a ready market where I could see where the price is at, simply because there is trading activity and there is a market price. So price, the closer to your price, the transaction at which you are able to exit, the better, the more liquid. Okay, the shorter amount of time you're able to exit when you want to sell or when you want to buy more, then that is a hallmark of a liquid market. Okay, can you say that of hard assets? Well, it depends, right? Real estates would always be valuable depending on their location, but by and large, the friction costs will never be as low as when you transfer common shares via the stock exchange, right? Stock exchange, you just pay the stock transaction tax of 60 basis points compared to the friction cost, no? When you pay the presumed capital gains when you sell real estate, the hard assets, right? We're not even talking about the maintenance and the holding costs, as well as the fees for the intermediaries compared to the fees for listed shares being transferred. When the brokers, the stock brokers, they're able to collect 25 basis points as by way of commission. So that's just really 0.25%, okay, by way of commission to the broker. So really, the fact that it's very portable, it's very liquid, and it gives you exposure to real property, to real assets. And not just real property, real assets, income-producing assets, right? That's the hallmark of an REIT. No? it provides for a vehicle so that investors can participate in the income producing real estate assets. Of course, in exchange for tax benefits given to the REIT corporation. Okay? So that probably is the reason why, or the reasons why the REIT mania is unfolding as we see today. Next slide. So, Republic Act 9856, otherwise known as the Real Estate Investment Trust Act, actually lapsed into law. But this was back in 2009. And this was at the back of opposition from the Department of Finance, then Secretary Gary Teves. During the Senate as well as the congressional deliberations, we started around 2007. Then it hit an all-time high in terms of the developments in 2008. And finally, in 2009, it lapsed into law. And I had the privilege of taking part in a technical working group on a weekly basis, especially in the Senate, as we shepherded this legislation through the Senate, through then Senator Edong Angara, and the House sponsor was then Congressman Sani Angara. Okay, so what is an REIT under Republic Act 9856? By definition, a REIT is a stock corporation established principally for the purpose of owning income-generating real estate assets. And this definition, this characterization, is not something that is peculiar to the Philippines. In fact, if you go to the US markets, the very first REITs there were organized as business trusts back in the 1970s. And back in the 1970s, they already had a lot of REITs that were being organized to take advantage of the tax incentives given under their tax laws. So in the Philippines, we adopted that definition. It's a stock corporation established principally for the purpose of owning income-generating real estate assets. For the lawyers, you might say, is this a special purpose vehicle? Well, that was the intention, that this be an SPV, and the legal title over the real estate be held by the special purpose vehicle. Of course, if you look at the nuances of the law, there are other alternatives to structure your REIT vehicle. But the essence of an REIT is really to provide for a corporate vehicle so that investors can have active participation, passive participation by way of passive income or dividend income in exchange for their investments in that REIT. And as well, in exchange for the REIT availing of tax incentives as a stock corporation. So we'll go through a little bit more of those details in the following slides. Okay? Now, first point I'd like to highlight is that, well, while REIT is organized in structure as a corporation, okay, while it is called a trust, we just decided to retain letter T in REIT because we were toying around with the idea of maybe we should call it REIC or Real Estate Investment Corporation. But, why reinvent the wheel? The jargon is very much accepted globally. And so we thought we'll just include the same by way of the denomination. Is still a real estate investment trust. And we explicitly mentioned in the law that while it's called a trust, it is not a trust because the organization will have to be as a corporation under the revised corporation code. In the US, trusts and associations, in addition to corporations, were allowed as alternative vehicles for US REITs. Now, it's not a regular corporation because there are a lot of benefits and there are a lot of nuances and required regulatory compliance for an REIT to continue as an REIT and avail of the tax incentives. The minimum capitalization under the law, Republic Act 9856, is at least 300 million paid in capital, whether that's cash or property. Okay. Now, if you look at letter B, that would probably be a factor for consideration when you think about structuring an REIT, right? When you're incorporate, the way you would probably go about it is you would infuse the income-producing real estate and transfer it into the REIT corporation in exchange for 100% of the shares of the REIT corporation. Right? Under the tax code, that's what you call a property for share swap, right? I would swap, subject to valuation requirements of the SEC, the income-producing real estate, whether that's just a singular property or several properties at the time of incorporation, and that would be my capital in exchange for 100% of the issued and outstanding shares of that REIT corporation. So the shares will most naturally be issued in favor of the sponsor. So for example, if it's a REIT, the sponsor would be Ayala Land Inc. The sponsor would be the real estate company that infused the income-producing real assets into the REIT vehicle. Okay. Other requirements for an REIT, there are independent directors requirement of at least 1/3 or at least 2, whichever is higher, in the board of the REIT. And letter D is something that's very peculiar, simply because the law requires an REIT to register with the SEC pursuant to Section 8 of the SRC, as well as to conduct a public offering via a registered exchange or to list. And for listed companies, there is what's called a minimum public ownership, right? The MPO requirement. The MPO requirement for REIT is that it shall at all times have at least 1/3 of its outstanding capital stock in the hands of public shareholders. When I say public shareholders, it's a very simple definition. I always keep in mind. Public is anyone other than the insiders. When you say insiders, these are the principal stockholders. These are the REIT sponsor, management, directors, related parties of the principal stockholders, right? The residual stockholders, which are unrelated to the insiders, would be classified as the public shareholders. So if you look at an REIT, the outstanding shares will have to be held by the public to the extent of at least 1/3. It could be higher. It could be, let's say, 51%, okay? But really, if you're the sponsor, normally they would like to retain control. And that's a very good signaling as well to the investors, because with control, the sponsor could actually go about the strategy and implement the strategy the best way that the sponsor thinks for the benefit of all the stakeholders. Okay, so there's an MPO requirement for an REIT simply because it is required to be listed in the stock exchange. Okay, next slide, please. Management. Okay, always remember, when you look at an REIT, the concept is that investors should have participation to the extent of at least 1/3 of the outstanding shares to a professionally managed corporation, right? And how do you ensure that that corporation, the REIT corporation, is professionally managed? The way we implemented that, the way we structured that in the law, was to require that the REIT corporation engage the services of 2 managers. One is called the fund manager, and second is the property manager. We will go into the functions expected of the fund manager and the property manager in a little while. But that is the hallmark of professional management, okay? In fact, the law makes mention of independent fund managers and independent property managers. We had a lot of debate going into 2020 last year because the definition of independence could be interpreted different ways. And I have a couple of principles embedded in a couple of slides later on the principle of independence, all right? Now, the underlying asset in a real property, in real estate investment trust is a real property, which is income producing, okay? If it's not income producing, it will not qualify as the underlying asset for an REIT company. What's an income producing real estate? It could be an office space that you're able to lease out. It could be, for example, a hospital whereby you're earning regular income. It could also be, let's say, a mall. The big malls, they're able to earn rental income from their tenants. Could be an airport. If you look at public infrastructure, an airport is also income producing. Maybe an infrastructure, a tollway, a toll road is also income producing. And you know what I've seen in other markets, the definition of real estate has now evolved. So that if you look at other markets like Singapore, India, the US, Japan, Australia, they now have what's called warehouse REITs. They have data center REITs. They have telecommunications tower REITs. So there's a lot of potential opportunities for unlocking the value of real property, which has an income stream via a REIT vehicle. All right. So when we were discussing how we will define real estate or real property, we adopted the definition under the Civil Code, under Article 415, of what's denominated as an immovable property. And we have a snapshot later of the items enumerated under Article 415 included within the coverage of immovable property. So the REIT Act, the Public Act 9856, makes explicit mention that real estate shall have the same meaning as real property defined under the 415 of the Civil Code as it is used in the REIT Act. Okay? Letter G is a requirement, mandatory requirement for a REIT vehicle, right? It has to be registered with the SEC and it has to list with the exchange. Therefore, there is a registration requirement by way of the prospectus as well, or the REIT plan. being made available to the public. Remember, when you do an IPO, when you do a public offering, the way to communicate in the best way possible to the investing public all the material information pertaining to that issue or pertaining to the issuer, okay, would be via what's called the prospectus, which is probably around 200, 300 pages, including all the risk factors, including the financials, including the track record of the company, as well as who's running the company, the management, and the board of directors. So that's what you call the prospectus. But under Republic Act 9856, we call that the REIT plan. And it has to comply, nevertheless, with all the requirements under the Securities Regulation Code in order to fully, fairly, and accurately disclose all material information so that when investors do decide to invest, they would be apprised of all material information that a reasonable investor would consider in determining the viability of investing in an REIT. Okay, next slide, please. Listing is a requirement. In fact, if you fail to list, there would be penalties incurred by the REIT corporation by way of tax assessments, simply because there are tax incentives given to you whenever your structure is an REIT. In fact, Section 12 of 9856 makes mention that the 50% DST tax incentive or tax fiscal incentive that you enjoyed and will have to be will be assessed. No? There will be an assessment to the extent of the other 50% if you fail to list within a period of 2 years from the time you avail of the 50% benefit by way of reduction of documentary stamp tax, which adds up to be a very significant cost as well when you look at real property. All right. Letter I, dividend policy. A REIT is not a regular corporation. I say that because in a regular corporation, you can decide not to declare dividends for a particular year, right? When you look at the common shareholders, or probably would await the board declaration in a COVID year, you'll probably not be very optimistic that there will be cash dividend declaration, okay? And that's par for the course when you look at a regular corporation. For preferred shareholders of a regular corporation, it's the same. Even if I say I issued preferred shares, normally, let's say the dividend rate is 5%, cumulative dividend rate. Well, even if that's the case, if the board of directors does not declare dividends to the preferred shareholders, well, you will not, as a matter of right, be able to receive dividend income, right? Because that's a story for a regular corporation. For an REIT, it's a different story. Why? Because the law, Republic Act 9856, and other regulations require that the REIT corporation distribute, at the very least, 90% of distributable income, which is defined as net income adjusted for unrealized gains and losses and impairment adjustments. Okay? Again, dividend policy for an REIT, the law is able to mandate, okay, that the REIT corporation should declare to the stockholders distributable income to the extent of at least 90% by way of dividends. Okay? If they declare 100% of distributable income by way of dividends, all right, the next question is, what will be the tax impact to the REIT? And later on, we will see that that provides some sort of a tax shield already for the REIT. And I'll also go into a bit more detail on that in the next couple of slides, okay? All right, in the next slide, please. Immovable property under 415 of the Civil Code. Essentially, when you look at the first 5 and then the next 5 in the next slide, these are properties which are by nature immovable, or they are by destination immovable, or maybe even by incorporation, right? They are immovable by incorporation, immovable by nature, immovable by destination. So as long as you're able to fall within Article 415 of the Civil Code, then you have legal basis to claim that your real property, provided it's income producing, is qualified as an underlying asset for purposes of organizing a real estate investment trust corporation. So next slide, please. So those are the other enumerations under Article 415. Let's move on to the next slide. Okay, understanding REITs. Again, first point, REIT securities are equity securities, okay? They are not fixed income instruments. It's not a bond. It's not an obligation via a loan agreement, okay? It's a co-ownership, no? Whenever you issue REIT securities, and probably you're looking at the common shares of REITs, these are equity securities under the Revised Corporation Code. But they are not ordinary equity securities of an ordinary corporation. There are specific and special characteristics. Okay. Second point that I'd like to highlight: REIT securities generally possess voting rights, the right to dividends, and other rights under the revised corporation code. In exchange, there are characteristics for REITs, as mentioned in this slide. Minimum 90% dividend declaration requirement. Okay, this is mandatory. Second, professional management. You have the fund and property managers. As well, there is a requirement of an annual property valuation by an independent property valuer. All right. There are as well restrictions with respect to the mix of your assets. There are also restrictions on your gearing or leverage, maximum of 35% leverage. And as well, at least 1/3 should be held by the investing public when you list the REIT. And as you go through the life of the REIT as a continuing listing requirement. Okay, what are the benefits of an REIT listing? Let's take a look at the benefits. Next slide, please. To the issuer, okay, there's always two sides to a story. Whenever I get the chance to talk to potential IPO companies, you always look at the psychology behind the founders, right? Why are they considering going public? Well, back in the day, it was by reason of the tax arbitrage. No? I'd say it's a tax arbitrage, simply because compared to estate tax, going public as well as the transferability of the shares, this is what I call the intergenerational transfers, is a very attractive tax proposition. No? But now with the rationalization of the estate tax compared to donors tax as well as compared to the income taxes, probably it's less of a tax issue and more of access to capital as a motivation for the founders to list. Okay, if you list, you could actually fundraise overnight once you're already listed, right? You could do what's called a private placement. If you want to fundraise 100 million pesos overnight, the next day you have your 100 million pesos, assuming that you're able to market your security to qualified buyers. Okay, but essentially, access to capital beyond the banks, right? Of course, the banks will still provide the preferred access or the preferred funds provider for even the biggest corporations, no doubt about that. But nevertheless, you will run into single borrowers limitations under banking laws, as well as you probably would also like to maintain certain financial ratios, certain covenants in your loan agreements, certain covenants in your other financing agreements would require you to diversify. So access to capital is a very important benefit to the issuer. Other than the fact as well that you feel that when you list, you're already given a seal of good housekeeping. It's a seal of excellence. It's like you have come of age, no? From a private corporation, you are now a listed corporation. It's a milestone in a lot of ways for any company that would like to plan ahead by way of maybe a 10-year plan. Then being a publicly listed company definitely will be a milestone in the life of that corporation, okay? Substantial tax benefits. Why? Because this is a REIT corporation. Pursuant to Republic Act 9856, there's lower. It's not a pass-through entity, by the way. People mistake Republic Act 9856 for providing the REIT corporation with what's called the pass-through entity benefits. The answer is no. Unlike the US tax code, unlike other legislations in other markets, you as an REIT will still be taxed under the CREATE law, let's say at 25%, but you will only be taxed on the distributable income less. Okay, this is the feature that's very attractive for an REIT. You can actually deduct the dividends that you declared from distributable income, and you would, whatever remains, if there would be a remaining amount, would be subject to the 25% corporate tax. Okay, if you declared 100%, then effectively you look like a pass-through entity. All right, creditable withholding tax are also lower at 1%, and even before the removal of the IPO tax under the Bayanihan to Recover as One Act, back in 2009, the REIT vehicle was already envisioned not to attract any IPO tax when they go public. All right. Another tax benefit is that the transfer of real estate property to an REIT under tax-free exchange is exempt from the value-added tax. Okay. Now it is very clear, embedded in our laws via the Bayanihan to Recover as One Act, or the BARO, that the transfer of property under Section 40C2 of the National Internal Revenue Code, the tax-free exchange, will also not attract a value-added tax under Section 209 of the National Internal Revenue Code. Okay. As well, there is a 50% discount on the DST and on the transfer of real property. We adopted this from the SPAV law. The SPAV law is a 2000 law, and there were a lot of benefits given to the special purpose vehicles back in 2002. This Pablo is actually the inspiration behind the FIST law, the Financial Institutions Service Transfer Act. No? So we adopted that, and it's already as well incorporated in the REIT Act, 50% discount. All right. A third incentive or benefit, right? Whenever you talk to any business person or any founder, no, they want to come up with a valuation that is fair to them, right? Because if you are not a listed company, if you are in negotiations with respect to, let's say, another party would like to participate, by 10%, 20% of your company, the hardest discussion points would center on how much are you worth, right? You could probably engage a valuation provider, but as I always say, valuation is more an art than a science. It's all about the assumptions. It's all about the projections. And you and I can agree on as many valuation models, as many price points as there are probably methodologies. Okay. Now, if you're listed, it's very straightforward. I already have a market price, and we can just agree whether to add a premium or to subtract and come up with a discount compared to, let's say, a weighted average price. So it's market driven, right? It's not just the two parties agreeing, but really the wisdom of the market, right? A company which is listed is able to take advantage of what I call the price discovery benefit of being a listed company, right? There's price discovery. Every single time, every single second that the market is open, the market takes a look at developments about the company. Are there good news about the company? Are there not so good news about the company? And investors form investment decisions on the basis of that. Whenever they post, for example, a bid or an ask, whenever they want to buy, they post a bid, or when they sell, an ask, depending or as a reaction to, let's say, disclosures about good and bad events or information or updates pertaining to that listed company. This is what is called the market-driven valuation. And this is premised also on the efficiency of markets, right? Efficiency because your underlying assumption is that material information is impounded or is actually incorporated into the market price. Let's move on to the next slide. Marketing advantages, seal of good housekeeping. We already discussed that. Retain significant ownership of the property after listing. Simply because with the public float requirement of at least 1/3, the sponsors would be able to retain the 67% or 2/3 ownership of the property upon listing, right? The REIT sponsor still continues to manage the REIT assets through the fund and property manager, subject to the requirements on independence, okay? So it's not like you are divesting fully from the corporation just because it is structured now as an REIT. The answer is no, because investors would want a steady hand. Investors would like the vision of the founders and their strategic view of how they can move forward the company in order to achieve not just an appreciation, for example, in the stock price, but also regularity of income, right? When you look at REITs, the important thing to consider is how sustainable is the income stream, right? If it's based on tenants, we very well know that tenants will come and go. So the next question is, how are you able to smooth out the fluctuations in terms of the supply and demand dynamics in the real estate sector? So some REITs would have a healthy pipeline. They would have over 5 years a list of assets that they would like to infuse into the REIT company in order to improve the valuation of the REIT company, as well as to sustain the dividend yield, right? You're able to sustain the dividend yield and really provide a very attractive yield to the investors. Okay, so these are the incentives or the benefits to the issuers. Primarily, if you ask me, of all these benefits, I think it's the price discovery benefit. The founder is able to optimize, right? Normally, compared to book value, you would have easily, 20 times your book by way of valuation. And that's a big multiple, right? If your book value is really just, for example, 100 million, you would probably see a 2 billion valuation simply because you went public, right? That's a big benefit. Of course, years of the founder toiling and really making this a successful business would always culminate in a successful IPO for, in this case, the REIT Corporation. Okay, next slide, please. Now, we've gone through the very essence of an REIT. What are the benefits, okay, to the issuer? Now, let's take a look at the REIT regulatory framework, okay? These are the elements of the REIT regulatory framework. Of course, the main regulation, the main legislation will be Republic Act 9856, or the Real Estate Investment Trust Act of 2009. Okay, as implemented by the SEC, they came up with implementing rules and regulations for the REIT Act. Okay, the same way, the Bureau of Internal Revenue came up with the Bureau of Internal Revenue Revenue Regulations 3-2020 in order to refine the applicable tax framework for an REIT. And the PSE as well, because there's a listing component, we came up with the PSE REIT listing rules. All of these items number 2, 3, and 4, back in January of last year, we were able to line them all up, and we were able to finally launch REITs. And it took us 11 years since the law was passed, but definitely it was well worth it, simply because right now we could see that there's very intense and there's very warm demand by investors for an investment vehicle like an REIT. It's a new, I say it's a new asset class, no? Because it's not like the other listed companies, and it provides for the benefit of regular income as well as an uptick in the stock price to all investors. Okay. Now, the previous industry concerns on the MPO as well as the tax issues in the next slide. I'll be showing you just a brief background. Next slide, please. Minimum public float issues before with the SEC that actually put a monkey wrench when we were rolling out this product. No, the SEC originally required that the public float, right, the ownership of the public should be by the 3rd year from listing 67%. Right? Can you imagine? I will talk to Ayala, I will talk to SM, and I will talk to Robinson, and I will tell them, your choice assets, your best real estate, if you do a REIT, you will only own 33%. That's not gonna fly, right? Simply because investors and the founders would definitely have different points of view, right? The founders would like to continue the legacy. They would like to grow the business further. And if they're just a 33% owner, definitely they do not have majority control, right? And at the end of the day, the legal issue is under Republic Act 9856, the law only makes mention of a public float requirement of at least 1/3, right? Except that the way that was implemented by the SEC when they came up with their memorandum circular, at least 1/3 does not prevent the regulators from saying 67%, which to me is probably not gonna sound, that's not gonna fly, right? It does not make business sense to require that. All right. Finally, last year, the SEC lowered the minimum public ownership requirement to be consistent with the REIT law, so that now it is at the level provided for in the REIT law, which is at least 1/3 of the outstanding capital stock. Okay. And the penalty, if the public float requirement, remember, public float is a requirement on a daily basis, monitored by the company. The moment you breach, you fall below the 1/3, which is the 33% public float requirement for an REIT, we in the PSE will impose a trading suspension. And if you are unable to bring up the public float ownership to the minimum levels of the law, which is at least 1/3, then you will eventually be listed after 6 months. Okay, it's very costly for the investors as well. They will lose an exit mechanism. Very costly as well for the issuer. They will suddenly have a company which will have which will not have a ready market for trading, and probably its value would also suffer. Okay, but I just like to point out, we in our listing rules, if in the remote event that there is a delisting, we require the issuer, the REIT corporation, to conduct a tender offer. Right, a tender offer is really an offer to buy back the shares of the minority, so that there will be a final opportunity for the minority investors to liquefy and to monetize. No, it's so hard to sell if it's a private corporation, right, as compared to a publicly listed corporation. Okay, so that's resolved. Minimum public float issues. Now it's already aligned with the law, 1/3. What about the tax issues? Next slide, please. VAT issues. This was also resolved, no, under the train laws I already mentioned. Clearly, it is now exempt from the 12% value-added tax, because back in 2011, the Bureau of Internal Revenue came up with revenue regulations which categorically stated that the 12% VAT will apply to the transfer of property to a REIT in exchange for its shares. Now, I was telling them before, well, this is not in the ordinary course of business. I'm incorporating a REIT. I'm transferring income-producing real estate. Why will I be slapped with 12%? Okay? So, in the end, the train law finally resolved that legal issue and clearly provided that under Section 209 of the tax code, this will form as among one of the exempt transactions from the 12% value-added tax. Okay. Also, BIR removed the escrow requirement of the previous regulations for purposes of the 2-year requirement for an REIT to list, right? It is also burdensome, right? Because if you avail of a 50% discount for the DST and you are required by the BIR to place that in escrow, the benefits, and that will also be cost of money for you, right? Rather than that money or those funds being invested in income-producing endeavors, you're also just sitting idle, right, in the bank account by way of escrow. So that's been taken care of. Existing regulations right now, Revenue Regulations 3-2020 would not require that you place in escrow the tax benefits that you avail of prior to listing. Next slide, please. Now, I'd like to focus on the 1-year domestic reinvestment requirement. This is not in Republic Act 9856, but in the regulatory issuances by the SEC, in the regulatory issuance by the PSE, as well as by the BIR. The underlying premise is that the funds that are generated, right, by the initial public offering of an REIT will have to be used, devoted for domestic reinvestment, utilized for domestic projects, domestic infrastructure projects in order to finance and develop these projects, right? You cannot spend this offshore, right? Because if you do so, there will be penalties and there will be potential delisting that we will impose against the REIT. And we do this to be consistent with the idea that we're trying to develop the domestic real estate market, right? If you're fundraising a big amount of money and that is funneled back into the funneled back into the real economy by way of development of infrastructure projects of the sponsor, most naturally, then that would also have what's called a multiplier effect, right? A multiplier effect so that the economy at large will benefit therefrom. So maximum time for you to spend the amount that you fundraise is 1 year, right? 1 year. That is a requirement of the SEC in their implementing rules, as well reflected in the PSE listing rules. And we will require the sponsor and the promoter to undertake via firm undertaking that they will comply with the 1-year investment requirement. Okay, so this is an additional regulatory requirement by reason of the underlying premise of developing, right, the domestic capital market as well as the underlying economy. Next slide, please. All right. This is really a checklist. I just wanted to show you we've already discussed all of these. And this listing disclosure requirements for an applicant company will have to comply with these requirements. Okay, next slide. Real properties held by an REIT, we already discussed a while ago, as long as they are income producing. Okay, when I say income producing, I am referring to a track record. Okay, income producing in the capital markets pertains to the track record of earnings, right? So if a real estate is to be held by an REIT, then that has to have a track record, an earnings history, if you may, for a period of at least 3 years from the date of acquisition. All right. Second point, the investment in real estate. How do you invest in real estate? 2 ways. First is via direct ownership, meaning legal ownership over the real estate is in the name of the REIT corporation. That's one way, the traditional way. Second is you are a shareholder in a domestic SPV, and that domestic SPV is constituted to hold or own real estate, right? In short, by corporate layering, you would be a shareholder. The REIT corporation can be a shareholder in a domestic SPV, which would then have legal title over the income-producing real estate. That's an allowable investment under the REIT Act, okay? As long as the real estate acquired shall be free from all liens and encumbrances, as well as acquired property should be insured for their full replacement value as a requirement of the implementing rules, all right? So track record is very important. The idle assets will not qualify if they don't have an income history. So at least 3 years of track record for you to be even qualified for REIT purposes. Okay, next slide, please. Now, whenever you look at track record, what's the amount, right? You might ask, well, it depends. Do you want to list in the main board or do you want to list in the small and medium enterprises board or the exchange? Okay, Well, in the main board, we recently revised our main board rules. So the cumulative EBITDA requirement for the past 3 years is at a minimum of 75 million pesos. And in addition, for the most recent fiscal year, you would have to register a net income of 50 million if you want to list in the main board. Now, for smaller companies, they would probably be attracted to the SME board. And the requirement really is very attainable, 15 million pesos cumulative EBITDA for the past 3 years. Or, as an alternative, if you do not have 15 million pesos by way of cumulative EBITDA for the past 3 years, cumulative top line operating revenues, right? 150 million pesos. Okay? At least for the last 3 years, provided that you are able to demonstrate an average growth in the top line of 20% for the 2 years immediately prior to your listing. Okay? In fact, as an alternative, if still you cannot meet the cumulative EBITDA requirements, although this will not apply to an REIT, we have what's called a sponsor model. This is for high growth and technology companies. A sponsor-driven model IPO in the SME board will not will probably have companies which are startups, do not have track record, but still nevertheless see the benefit for a fundraising activity in the Philippine Stock Exchange. Okay, why is it important? Why is track record important? Simply because you are now dealing with retail investors, right? Retail investors would definitely want to be assured that you have an income stream already via the audited financial statements appended to your registration documents. Okay, can the track record be met through asset level track record for newly incorporated REITs? Good question, right? Normally, if I am an REIT, you would probably structure it so that the vehicle itself has not yet been in existence for the past 3 years. However, the assets have had a very long history of income stream. And so for REIT corporations, when you look at an IPO, the amounts by which you will be measured, right? Look at the main board, 75 million cumulative EBITDA, could be measured if you look at the asset level track record, right? How is the income stream of the asset level? Is it reaching the 75 million requirement, no, for purposes of a main board, or for an SME, is it 15 million assets for purposes of a SME board listing? Okay, and this has become commonplace because some companies were not able to prepare way in advance. No, some companies felt that they also would like to take advantage of the market opportunities, and so immediately conducted reorganization, a corporate restructuring, and infused the assets. And there you have newly incorporated REIT corporations, which have not been in existence or operating for the past 3 years, right? So we do consider the asset level track record for purposes of compliance with the track record requirements for listing purposes. Next slide, please. Dividend policy, very clear, at least 90%. And this has to be specified in your REIT plan because the expectation for investors is that they will derive annual passive income. At least the minimum is 90% of the distributable income. Okay, that's why I call REITs hybrid securities. No, they are equities, but they perform or they behave like bond instruments. No? They provide you an annual income stream. No, except that it's not a coupon payment, it's not an interest payment. In fact, it's better. It's a dividend payment on an annual basis. So this is a requirement for an REIT, mandatory requirement. Next slide, please. And this is how it should be when you look at the tax structure of a REIT, right? Please disregard 30% under the CREATE law that has become 25% already. So gross income less allowable deductions. And if you notice, dividend payments have been included as an additional deduction for purposes of deriving a taxable net income, right? For an ordinary corporation, you cannot do that under accounting laws. Dividends are not deductible expenses for tax purposes. But by virtue of Republic Act 9856, as explicitly provided for in the law, dividends paid and distributed will be qualified to be additional deductions for purposes of computing taxable net income. So if you look at the gross income of 100 million, less allowable deductions, for example, and whatever distributable income remains, you distributed it, then most likely your taxable income would actually be very minimal, right? Your taxable net income. This is the reason why our finance managers were really against this law. As I said, this just lapsed into law. It was very fortuitous that both the Senate and the House were able to reconcile their versions. And we now have, 11 years later, the benefit of this tax structure provided for under Republic Act 9856. Now, it's not a pass-through entity because you're still taxed as a corporation, but there is an additional deduction which will provide you effectively the benefit of a passive entity, no? A pass-through entity for tax purposes. Okay, so this is now under Revenue Regulations 3-2020 clearly provided for. Next slide, please. Tax incentives. Okay, the transfer will not attract VAT. There will be no IPO tax, and you can invoke 50% deduction, DST reductions. And as long as you're able to as well satisfy the requirements of the BIR, you have to provide an affidavit of undertaking to list within 2 years. And the stock transaction tax is at 60 basis points whenever you as an investor in the secondary market, right? Remember, when you do an IPO, that's a primary market. It's an original issuance. And the money in an IPO goes to the REIT corporation or to the REIT sponsors, okay? Now, I just like to highlight, when a REIT corporation goes public in an IPO, what I've seen for the previous REITs is that the selling shareholders would be the sponsors, right? They want to dilute the 100% ownership base of the sponsors into the legal requirement, which mandates that at least 1/3 should be in the public hands, right? So the best way to do that is for them to sell their existing shareholders via what's called a secondary offering via an IPO. And so the cash goes not to the REIT corporation, but to the sponsors, right? And so that is why the reinvestment requirement is also an undertaking by the sponsors and the promoters, because they derive the cash via the IPO simply because the secondary offering, the shares that they already hold, are being sold in the IPO to the investing public, in exchange for which the investing requirement for minimum public float is satisfied. Okay, next slide, please. A point that is also very attractive for overseas Filipino workers is that the dividend tax is something for the next 7 years, right? From 2021, from 2020 rather, no? So from 2020 to 2027, our OFW, our overseas Filipino workers will not be subjected to the 10% dividend tax, the withholding tax, right? For the next 7 years, as a way to incentivize the OFWs to invest in REIT instruments, even overseas. Now with online trading, it's very convenient for even Filipinos offshore to participate in the opportunities in the financial markets. All right. Of course, the dividends paid will be subject to tax. If you're not an OFW, then if you're a retail investor, 10% withholding. If you are a corporate investor, intercorporate dividends will not be subject to withholding tax. Okay, withholding tax for the income payments subjected to the 1% creditable withholding tax pursuant to the BIR revenue regulations. Next slide, please. Fund manager. This is a very important, sticky issue. Wow, before 2020, the question was raised, no? Why will I allow a third-party fund manager if, for example, I am Ayala? Why will I allow a non-subsidiary to manage my property for me, right? Why will I allow a third-party fund manager to manage my property for me? Well, the debate that was ongoing then was that, well, it's because you are able to invoke very preferential tax benefits as a REIT corporation, right? The fact that the revenue foregone on the part of the government, in exchange for that, you have to demonstrate that management of the property and management of the funds of the REIT is in the hands of professional managers, right? Now, based on our benchmarking in other markets, the concept of independence came about, right? Does it mean that independence means totally unrelated companies, totally unrelated fund managers, totally unrelated property managers? Or does it simply mean there are governance requirements to the end in view that centralized management is independent between and among the REIT corporation and the fund and property managers, all right? And so we resolved that issue by coming up with independence principles or requirements by way of engaging a fund manager or property manager, right? So SEC limited the participation of REIT directors, okay? The company that will go public, their directors, sponsors, and promoters, right, cannot occupy more than 49% of the board. In short, the interlocking directors, right, the common directors between the REIT corporation and the fund manager, as well as between the REIT corporation and the property manager, should not be more than 49%, meaning 51% would be outside directors, right? 51% would be outside directors in the board of directors of the fund manager, as well as the property manager. That's point number one, okay? The second point, majority of the members of the REIT fund manager must be independent directors, all right? As defined in the SEC regulations on corporate governance, independent directors is one, and you are independent of the company, right? In the fact that you do not hold more than 2%, for example, of the equity interest, and you're not a lawyer, you're not counsel, you did not perform advisory services, you're not a principal stockholder, you are not part of management, right? Then you're able to comply with the requirement of independence, all right? So for publicly listed companies, the requirement is really just 20% of your board, right? But in this case, it's 1/3 or 20%, whichever is higher. But when you look for the REIT corporation, right, that's a requirement for independent directors. But when you look at REIT board of directors of the fund manager, the requirement is that majority, right? Majority of the directors of the fund manager, as well as majority of directors of the property manager, right, will have to be composed of independent directors. Okay, those two were actually the principles that paved the way for the launch of the REITs. No, we were able to unlock and we were able to solve this issue on independence, right? Simply because we cannot lose sight of the reality that if you are the sponsor, you're the promoter, you would probably engage a related company to manage your real estate, right? Especially if that's your crown jewel, especially if you have an income stream, right? That you have a big stake in that corporation. So this is, in a way, relaxed the requirement of independence, but nevertheless included governance requirements at the board level to ensure that the professional management is still there, notwithstanding the potential conflict of interest, right? Independence and is always a question of perceived or actual conflict of interest. And this is the resolution by way of the implementing rules to the Republic Act 9856 or the REIT Act of 2009. All right, let's move on. Now, how do you register? How do you comply with the requirements if you're a fund manager? Well, there is, just like to mention, between a fund manager and a property manager, the requirement is for the fund manager to be licensed as a fund manager of the REIT. There is no equivalent requirement for licensing with respect to a property manager, all right? But both have to be registered with the SEC. And there are capitalization requirements, track records, as well as, I would say, a suitability test, the fit and proper test with respect to their directors and officers, both at the fund manager level and the property manager level. Now, let's take a look in the next slide at the functions of the fund manager, right? Essentially, if you're the fund manager, you're actually tasked to implement investment strategies. Consistent with the REIT plan, you have to make sure that you're able to select suitable and attractive income-generating real estate so that you will be infusing these real estate over time. Maybe for now, you probably have the first three, for example, in the case of a REIT, they infused 3 assets. And then the year after that, they infused a couple more assets, right? So you have to be able to sustain that. And the determination of the proper implementation of the strategic objective of an REIT pursuant to the REIT plan will be the function of the REIT fund manager, right? Implement investment strategies, oversee, coordinate property acquisition, right? As well as leasing, operational, financial reporting, and well, including refinancing and asset disposition plans, right? Essentially, even the valuation will have to be overseen by the REIT fund manager, compliance with the requirements under the law on gearing, on investment and borrowing limitations, as well as making sure there's proper insurance. These 4 main functions pertain to the fund manager's responsibilities to the REIT corporation in compliance with the requirements of the REIT Act, okay? Now, let's move on. What about the property manager? The functions of the property manager, right? Essentially, he acts as the professional administrator, right? Those in the real estate sector would be most familiar in that the property manager would manage all the aspects, including planning the tenant mix, making sure that you're competitive, right? What are the potential tenants in the short, medium-term plan? What are the leasing strategies? What are the conditions? And how do you comply with the regulatory requirements of the local government or even the national government, as well as tenancy administration work, right? including maintenance, refurbishment, really property management of, especially if you're looking at an REIT corporation. This is very important, right? Because a property is as good as how well it is managed, right? Even if it's probably a dated old property, if you're still able to manage the facilities of that property, real estate property, then you're able to nevertheless optimize the value of that property. So that is within the jurisdiction as well of the property manager. Okay, these are the functions of the professional manager, that is the property manager. Okay, next slide, please. Now, a question that I always receive is, if I'm a REIT corporation, can I be engaged in property development? Okay, general rule is no, right? Why? The view or the vision for an REIT is that it is limited to the incurring income, right? It is limited to generating income by reason of its income-producing real estate already, right? It's not in the business of development, right? If you, in fact, the REIT law provides for limitations, right, on the development activities or the properties to be developed by the REIT corporation. There is a 10% maximum limit on the amount of deposited property which are yet to be developed, right? What that means is that a REIT corporation, because of the tax incentives, right, that is given by the state, is envisioned not to be a property development company. If you are in the property development sector, then you are by all means able to do your business and even be a listed company, but not as a REIT corporation, right? You will be taxed the normal way a regular corporation is taxed, and you would be governed by the regulatory requirements for an ordinary corporation, okay? However, as in any law, there are exceptions. A REIT shall not undertake property development unless, so these are the conditions. Number one, if you intend to hold in fee simple the developed property for at least 3 years from date of completion, or the purchase agreement, and rather the purchase agreement is subject to the completion of the building, so that the investors will not be exposed to construction risks, then that will be a legal requirement. Third, the development of the real estate shall be carried out on terms best available for the REIT, which are no less favorable to the REIT than an arm's length transaction between independent parties. Okay, as well, and finally, well, there has to be a reasonable expectation of a favorable outcome of completion, right? In fact, the total contract value of properties under development should be less than or equal to 10% of your deposited properties for an REIT, okay? And so the general rule really is, if you're into property development, well, that is not a REIT structure. That is not a REIT vehicle, okay? If you look at these conditions, then that would already disincentivize a property development company for purposes of structuring itself as a REIT corporation. Next slide, please. Let's move on. Allowable investments. I'll just go quickly with these ones. Real estate. It is allowed to invest in real estate, whether by way of leasehold or freehold, right? At least 75% of the property deposited in the Philippines shall be income generating, okay? Deposited property in the Philippines, no less than 35% of the total deposited property. Foreign, the maximum of 40%, provided SEC gives its green light to you, right? Special authority. This was very sensitive, especially to the Department of Finance when we were crafting the implementing rules and regulations, because necessarily they did not want the money to go out of the country, right? That's why there is a requirement for special SEC authority before you could actually invest offshore, and subject to a maximum of 40% of your deposited property, okay? Another point is investment by direct ownership of the real in real estate or by direct shareholding, as we discussed in an earlier slide. These are the options for the REIT corporation with respect to investment in real estates, okay? Next slide, please. Real estate-related assets could pertain to debt securities issued by listed property companies or other funds and assets, personal property incidental to the ownership of the real estate, regardless of whether they are where they are located or incorporated, issued, or traded. These are qualified as allowable investments by the REIT by way of real estate-related assets. Next slide, please. Managed funds, debt securities, and listed shares. You are within your prerogatives under the REIT Act to invest, provided that you do not put all your eggs in one basket. There is a single entity limit of 15% in any one issuer securities. except if you are referring to government securities. No? If you're looking at government treasuries, government bills, or treasury bonds, the limit is 25% of your investable funds. So it's a higher take-up simply because these are also probably risk-free securities, right? When you look at government instruments, these are risk-free. And so you're given a higher leeway, right? 25% of investable funds. Other allowable investments as well provided for in this slide for your reference. Next slide, please. All right, joint venture. Can I engage in a joint venture and set up a REIT? Okay. Well, yes, that is allowed. When investing in an REIT is a joint venture, the REIT, the legal requirement is that the REIT in a joint venture agreement or JV, in a corporate JV, should make such investment by acquiring the shares in an unlisted special purpose vehicle. Right? In short, that will allow the REIT to have freedom to dispose of that investment. Right? It will acquire the underlying shares of that unlisted SPV. Okay, that's one way. And the joint venture agreement or memorandum or articles of association will have to grant the REIT veto rights. No, if that is unincorporated, then that will have that agreement at a minimum will have to give veto rights to the REIT over key operational issues of the SPV or the special purpose vehicle. Okay, yes, you can engage in joint venture arrangements as an REIT. You are allowed by the express provisions of Republic Act 9856. Next slide, please. Related party transactions. When you look at the REIT structure, it is what I call pregnant with conflicts of interest, right? It's pregnant with conflicts of interest, simply because the fund manager and the property manager are related to the REIT corporation. And the sponsor is the one that would probably be the most natural and logical source of income-producing real estate. Remember, if it's a REIT, the sponsor is Ayala Land, and it would have related parties to manage its funds and its properties, right? So, very clear in the law that there are minimum requirements for contracts between the REIT and its related parties, right? Because of the conflicts of interest that are embedded within the very structure of an REIT, right? And the requirements I reproduce for your reference: full and fair disclosure of the identity and the complication. No? Why is it a related party? The fairness and reasonableness, not just of the price, but also of the other terms and conditions, will have to be complied with. And there has to be an approval by at least a majority of the entire membership of the board of directors, subject to including the unanimous vote of all independent directors, with a fairness opinion and all that. Okay. Now, however, if it's a related party transaction between the REIT and, for example, a director or officer, then you will go to the revised corporation code, particularly section 31, which would require similar conditions, no, for purposes of making sure that the transaction is full and fair, as well as arm's length, right? It's on an arm's length basis, despite the fact that these are related parties. Okay, so if it's between corporate to corporate, REITs and its related parties, especially the fund manager, the property manager, or even the sponsor, the promoters, then you would have to comply with the following provisions, as you could see on screen. Okay, let's move on. From related party transactions, we also have the sponsor model. I mentioned this earlier. This really provides for another avenue for an SME listing, but in the context of an REIT, you would probably be hard-pressed, because unless you're able to define your business as a high-growth business, right? Because the sponsor model, we adopted this from the London Stock Exchange model as well as the Singapore Exchange model, whereby high-growth companies in need of cash and want to do a public offering do not have the track record or do not have the minimum levels of retained earnings or stockholders' equity, right? But for your reference, I nevertheless include that as you may have other clients who may be looking for a SME board sponsor model IPO. Next slide, please. There are, however, prohibitions if you're looking at an SME board listing. No? Normally, for the main board, we would allow listing holding companies, no, or portfolio and passive income companies, because that's the main board. There's a stock record of a certain level, and that is allowed under the main board. But for the SME board, it's a different story. We only allow the listing of a holding company in the SME board if that holding company has an operating subsidiary, right? Meaning it does not purely engage in investing in equity securities of as well passive companies, right? So And generally, we will not require the listing of portfolio or passive income companies in the SME board, except if that holdco or that holding company has operating subs, and then in which case it will be able to invoke that exemption and list in the SME board. Okay, and please note, we probably heard a lot of backdoor listings. No, why will I go through a front door when I can go through a backdoor listing? Well, the answer is, well, if you're going through an SME board listing, that is not allowed. In the main board, can I do a backdoor? Yes, it's legal. But do I encourage it? No, because the costs are there. Might as well take advantage of the benefits of an IPO, do the full book building, do the full price discovery, marketing, and you have your vehicle listed, no? Compared to doing a backdoor, changing the purpose, changing the business, infusing assets. Now, it could add up as well. Of course, the beauty of a backdoor, based on what I have seen in the market, is what they're saying is that they're not forced to go to the market and fundraise by reason of them being listed for the first time, right? If you're doing an IPO, it is firmly underwritten. You cannot back out, right? When you announce that you will do an IPO and you register, and suddenly the market turns against you for some reason, there's a pandemic, by come hell or high water, you have to conduct your IPO. And that is the feature of an IPO. There's a firm underwriter, right? It cannot be a best efforts only. So in the case of backdoor listing, they always say, well, it affords me more time, and so I like that better. But of course, the costs would also add up in a backdoor listing, okay? So if you're looking at an SME board, it will always have to be a front door listing for purposes of the PSE listing rules, okay? All right, next slide, please. A domestic reinvestment property, reinvestment policy rather, very clear, 1 year, and this pertains to the following, okay? Please take note, please remember, these are the two sources of revenue, sources of proceeds rather, which will be then covered by the reinvestment policy, okay? First source, secondary sale of the REIT securities. And that happens normally during the incorporation stage, right? When you incorporate, right, you infuse the assets in exchange for shares of stock, right? And those shares of stock, okay, you will then offer to sell during the IPO, right? Because as I said, you want to dilute your 100% ownership and bring it down. And so that's what we call the secondary sale. And so the subsequent sale of REIT shares which were issued, those securities you obtain because you exchange, as the promoter, you exchange your income-generating real estate. Whenever that happens, you will have cash on hand and you will have to comply with the reinvestment requirement of the implementing rules, no? Domestic reinvestment requirement within a period no later than 1 year, okay? That's the first source. What's the second source? During the life of a REIT, there will be cases where the promoter will again sell, okay? It could be a sale from the promoter to the REIT corporation, from Ayala Land, for example, to a REIT, no? And the proceeds that are derived by the sponsored promoters from the sale of an income-generating real estate infused to the REIT post-IPO during the life of the REIT as a listed company, those proceeds will be covered by the domestic reinvestment policy as well, right? So if you have a domestic reinvestment policy at the time of IPO, that will be amended, and 1 year from the time of the sale, in the second instance, that would again be subject to the 1 year period by which you are supposed to reinvest the proceeds from the sale from the promoter or the sponsor to the REIT vehicle. There are only two cases by which the reinvestment policy will find application, and these are the ones that I covered in this slide. All right, next slide, please. These are reiterations already incorporated, so we can skip this slide. Next slide. And the parties that are required to comply, we already made mention of them: sponsors, promoters, and the proceeds. Okay, depends on the transactions which you would justify by way of use of proceeds, right? A question I always ask: can I use it to pay off debt? Okay, answer yes, for as long as that debt was incurred for development purposes by the promoter. All right. If that debt was not incurred in connection with the property acquisition and development, then that does not qualify as a domestic reinvestment use of proceeds. All right. So this is actually where there are normally a lot of questions. No, what would qualify by way of domestic reinvestment? Simply because it is time bound, 1 year, right? And we in the exchange will guide you if you are planning to do a REIT IPO on what would qualify for purposes of the REIT domestic reinvestment policy. Okay. All right. Next slide, please. Reporting obligations, again, in connection with reinvestment policy, you can just read this at leisure. I'll provide a copy of this slide anyway. Next slide, please. The reinvestment plan is embodied in a firm undertaking by the promoters, not just to comply, but as well regularly report. Now, we monitor this on a quarterly basis. So 4 times in the year, we will be getting the report. And sometimes it's actually just, there's a balloon disposition of proceeds, no, utilization of proceeds. And that's because milestone-based, right? There are property developments, property projects, or, it's milestone-based. Therefore, you'll probably see a full utilization towards the end, not so much in the first few quarters. Okay, that's perfectly okay. That's allowed, no? As long as you disclose that to the investors via our disclosure system. All right, next slide, please. Structured reports, as I mentioned, and the reinvestment report will be made public. No, these are all downloadable from what's called the PSE Edge. If you're already invested, please download that in your phones, so you could, on a real-time basis, download any and all disclosures, not just the reinvestment reports, but also other disclosures about the REIT corporation. If suddenly there is a declaration of dividend, then you could immediately be informed. If there is a corporate reorganization, you could be informed, or any other corporate actions, no, restructuring. The distribution channel is actually our online PSE Edge portal. So please feel free to download that. That is downloadable for free, by the way. Okay. So next slide, please. And finally, the feature of an NOCD, I'd just like to highlight, name on central depository compared to a regular listed company. Okay. Other than a dollar-denominated security, okay, DDS. I'm not sure if everyone has been informed. We've already had a couple of dollar-denominated securities which are listed. No? They're also on what's called NOCD structure, right? NOCD means, in its barest essence, if I'm the investor, I am able to view the outstanding balance of my investments without necessarily asking for the balance from my broker, right? For an ordinary listed corporation, that is not the case. Normally, it is the broker that will provide you the balance of your securities lodged within the PDTC, which is our Central Securities Depository. Remember, all shares that are listed and traded in the market are scriptless. No? They are immobilized. No? They are not certificated. They are already lodged with a depository. Okay, and the structure of our depository is that the legal title is in the name of a special purpose vehicle, so that no matter how many times you transfer the shares, the ownership never changes. It's in the name of the SPV, the PCD nominee corporation, as we call it, right? So an NOCD structure would pierce through the nominee. Okay, you would be able to get your balance, and this is an investor protection feature required of REIT corporations. So the brokers, your brokers, when you subscribe to an REIT IPO or any other public offering, for that matter, you are only able to trade if you already have an NOCD account. And this is a very simple creation process. No, it's a sub-account from the account of the broker. You will then be able to access, you'll be given access, so that information will readily flow from the depository. Remember, you want to make sure that your investments are intact, right? That the intermediaries are not disposing of your investment without your consent, right? So this is a very important investor protection feature for REIT investors. Okay, next slide, please. And this is a graphical representation. No? The right-hand side of the slide, you would see the REIT. You will have the omnibus account. Omnibus account meaning the nominee account, and that's PCD nominee corporation. That's the omnibus account. And underneath, you would have the names of the respective beneficial owners, as we call it in law, the ultimate beneficial owners, whether you're Filipino, non-Filipino. You'll have access, no, in terms of validating your balances. Very important feature of REIT for investor protection. All right. Okay. Next slide, please. The penalties we've already discussed. We can just skip this. And next slide, please. Takeaways. Okay. After all is said and done, what are our key takeaways? First, key takeaway, game changer. REITs are a different instrument, right? While they are an equity security, right? They are shares of stock, okay? They are not like an ordinary corporate share of stock, right? There are required dividend declarations, therefore they provide stable yields for bond instruments, okay? there is dividend yield of REITs attractive to both institutional and retail investors, right? So it's technically a hybrid instrument, right? It's between a stock and a bond, but unlike a bond instrument, there are no call options, right? If you look at the bond instrument, normally the issuer, if you're a publicly listed corporation, will embed within the bond instrument what's called a redemption feature. Okay, normally on the 3rd anniversary year of the issuance, there will be an optional redemption. By the 5th anniversary year, there will be a mandatory redemption, meaning I will buy it back. And that's to protect the risks, the interest rate risk that an issuer or a borrower is exposed to, right? They would like to refinance if in case the interest rates go down. They would just like to pay back the creditors and pay them back their principal, of course, with a certain premium, and just borrow again at a lower rate, right? In exchange for which they're able to refinance existing debt. Okay, that's a loan agreement or a fixed income security. A REIT instrument, however, does not have that call option, right? Why? Because it is a share of stock, right? Well, you might ask, what if it's a preferred share? Okay, well, okay, common shares, when you do an IPO, right now the model that we have is that you will have to issue common shares. Okay, question: can I do preferred shares in my IPO? We have not yet encountered that situation, but based on our benchmarking in other markets, the preferred shares normally are non-voting, right? Normally are non-voting compared to common shares which are voting. Now, voting as defined in the Gamboa case, you're able to elect in the stockholders meeting the board of directors. So for now, our policy interpretation is that REIT common shares will be the IPO route for an REIT corporation. Okay, second important takeaway. What is the legal structure? What is the nuance behind an REIT corporation? Well, I say it's evolving and innovative, okay? There is a lot of innovation. The lawyers as well as the underwriters are coming up with different structures. But really, if you ask me, it's either you already have the real estate already with a building or with the income producing structure, and you go public with that vehicle, or it could be that you convert a development corporation into a REIT corporation. I've seen a lot of structures like that. They will go through an amendment of the Articles of Incorporation. They will go through the SEC, convert it from an ordinary corporation to a REIT corporation. Okay, development to REIT corporation. Okay, the holdco structure is also a possibility. A JV structure is also a possibility. Okay, there's a lot of legal structuring involved to make sure that you're compliant with the myriad of regulations. Okay, it's evolving. Takeaway number 3, it's evolving. We're not just looking at the plain vanilla REITs, right? The definition of real property allows for industrial REITs. The definition allows for gaming REITs. In the case of casinos, it allows for healthcare REITs. In the case of hospitals, hospitality REITs as well, tourism destination. Simply because these are all classified or may be classified as real property. Okay, as long as they are income producing, they will qualify as real property. Mandate of the REIT. I think this is a very important consideration as well, right? When you say mandate, if the sponsor is to dispose of income-producing real properties, does the REIT have first dibs? Does it have first crack over a property that is to be disposed of by the sponsor? That has to be very clearly spelled out in the REIT prospectus, in the REIT plan. No, when I review REIT plans or prospectus, that has to be explained clearly. What are you just looking at office REITs? So that if there are opportunities, let's say in another sector, then that would not be within the allowable investments of the REIT. So the mandate of the REIT is very critical. Why? For foreign institutional investors, this is something that they use to make sure that they are diversified. Number one, okay, they don't want to be fully concentrated in a particular real estate sector. So the mandate of the REITs is a must-have, especially for the foreign investor. Okay, next question. Is there a right of first refusal in favor of the sponsor? Then you could structure it in order to probably provide for stability, right? If there are attractive assets in the stable of the sponsor and you provide for a right of first refusal, this should have read in favor of the REIT, right? If the sponsor is to dispose, then it can only sell it to third parties if the REIT says, I'm not interested. Okay, so that option in favor of the REIT corporation would also be favorable if you look at the mandate of the REIT. And finally, yields will always be the story behind REITs, right? Yields. When you look at yields, it's not just dividends, but you look at total returns. Total returns we define to be dividends plus uptick in the capital, right? Compare that with your 10-year government bonds, doing what, 4%, okay, and your tax 20% passive income tax, whoa, it will not compare. And if you have your dividend income, you're only taxed 10%, right? So there's already a tax arbitrage in favor of dividend income, not to mention the rate itself, right? And so those are the 5 key takeaways for REITs. Just to close, I'd just like to highlight a couple of fintech initiatives or updates in the next couple of slides that I think is very, as well, very important. Let's take a look at the fintech developments. Next slide, please. Cryptocurrencies, virtual currencies, distributed ledger technology. I'm pretty sure you see this a lot in your practice as an investor, when you read social media, when you look at, for example, news reports, where last night the price of Bitcoin again reached 40,000 US dollars per Bitcoin. There was a time that was just doing $1,500 back in 2017. Can you imagine? That was 1,500 per Bitcoin 4 years ago. Now it's doing 40,000 pesos. What are Bitcoins, cryptocurrencies? My question there is, are they securities? Okay. I'm interested because if you say they are securities, then there are regulatory requirements before you publicly offer securities, right? Under the Securities Regulation Code. If they are not securities, if they say they are utility tokens, they are instruments which are being used to pay, right? Similar to fiat currency. If you're saying they are digital currencies, they are not securities, then that will have to be a policy discussion. In fact, the central bank, in the second point here, has already issued their guidance documents, rules, with respect to virtual asset service providers, or VASPs. There are now licensing requirements as well as allowable activities to be pursued by what once was called virtual currency exchanges, now renamed virtual asset service providers, or VASP. No? The fact that it was called virtual currency exchange before, during the time of then Governor Ernestina Espinilla, served to confuse practitioners, including myself, right? Because if you are called a virtual currency exchange, then you can only hold yourself out to the public as an exchange if you're actually registered with the SRC, with the SEC as an exchange under Republic Act 8799, the SRC, right? Well, fact of the matter is the exchanges out there trading virtual currencies are not registered with the SEC, right? So virtual currency exchange rules will have to be issued not by the BSP, but by the SEC, okay? Why is this important? Simple. What did we learn in the 2008 financial crisis, right? A lot of things. Number one, if you trade through an organized market, through an exchange, there's risk management, collateral management, better than when you trade over the counter, right? As we saw in 2008, when the market turned against the different participants, if it's an over-the-counter trade, then you don't have a central counterparty, right? You don't have someone in the middle who will make sure that the transaction will push through. If it's an exchange-traded transaction, there is a clearinghouse, right? That's why if it's an exchange transaction, central counterparty risk is as close to zero as possible, right? Why? Because our clearinghouse, by the principle of novation, becomes the central counterparty, right? The buyer to every seller, the seller to every buyer, right? So if these virtual currency exchanges, I'm not saying it is a risk that we would like to take. The policy debate here is they should be registered as an exchange if they hold themselves out as exchanges, right? In which case there would have to be risk management parameters to protect investors, okay? I think the debate on cryptocurrencies is actually overshadows the benefits of distributed ledger technology, DLT, right? A decentralized platform which is able to validate. No, they say it's immutable. You cannot change, right? The hash, the system. It will provide for distinct securities via what's called the distributed ledger technology. Okay, I see appropriate use cases that can probably be used for land registration, subject to revision of our land registration laws, and smart contracts. I think this is now being used. Smart contracts pertaining to transactions, buy and sell transactions, smart contracts including escrow agreements. Remember, when you look at distributed ledger technology, you're trying to plug an element of trust, right? If you don't trust the counterparty, then there are ways and means using distributed ledger technology by which you are able to verify that you will only perform your end of the obligation if there is confirmation that the other party has already performed via distributed ledger technology. Okay, so these are use cases, I think, that are appropriate and suitable for distributed ledger technology. Land registration and smart contracts, and most especially for escrow agreements, right? Without human intervention, I can already come up with an escrow setup using distributed ledger technology, whereby a key will be provided prior to the release of, let's say, the asset or the funds, to ensure that there's already fulfillment of the escrow conditions, okay, using distributed ledger technology. Next slide, please. Securities token offering. How is this different from initial coin offering? An ICO normally is when you issue coins to the public, right? And those coins normally are the digital currencies, right? When I say securities token, this is more along the lines of a security defined as an investment contract under securities laws, right? An investment contract is when there is a transaction in cash pooled with other investors with the expectation of profits primarily through the efforts of others, right? How we test. So securities token offering would comply with that requirement. And these security tokens actually are called derivatives, no? Because there's an underlying asset, you create a derivative instrument, and you issue that to the public, right? So this is the way of the future already when you look at the digital representation. For example, an art piece, no? Right now in the crypto space, we have what's called non-fungible tokens, NFTs, right? If you have a very expensive work of art by a master, in other jurisdictions, they're already able to create cryptocurrencies via a non-fungible token and do a fundraising via a securities token offering, all right? And crypto assets can also be used via as crypto escrows, rather, crypto technology, smart contracts, the codes that function like an escrow agent as an alternative. And finally, just to end our discussion, we already have what's called direct market access, online trading, which also occasions a potential for high-frequency trading for everyone. Okay, so after all, I think our market is evolving. We are not where we were 15 years ago, 16 years ago when I first joined the exchange. We are progressing by leaps and bounds. But nevertheless, I think we still have a long way to go, right? Whether it be in the REIT market, I long for the day when we can be as competitive as Singapore, as Australia, Japan, and the US when you talk about real estate investment trust. We evolve as a market. There are more products, not just long-only investors. There will probably be a lot more derivatives. And I think there's a lot of opportunities for us lawyers or those in the management to take advantage of these opportunities, notwithstanding the fact that we are in a new normal post-COVID. So thank you again for your attention. And should there be questions, I would be more than happy to address your questions.
Thank you very much for that comprehensive presentation. It was really very helpful to everyone, and I believe that a lot of our viewers learned from your presentation. So, Anvic, do we have any questions coming from the floor? Okay. Let me read this for you. Can one of the purposes of the REIT IPO is to use the proceeds to pay off existing loans of the REIT company, so the existing mortgage on the REIT property will be canceled?
That's a good question. That presupposes that there is a primary offering. Okay, as I mentioned earlier, I just like to highlight, when you do an IPO, you could opt to do 100% primary issuance, which is coming out from the unissued, in which case the cash would go to the REIT company. So this question presupposes that there is a component. Let's say I'm trying to fundraise 10 billion pesos via REIT IPO. There's a component whereby there is primary shares being issued. So the answer is yes. You can mix a secondary offering. Remember, you're doing an IPO to comply with the minimum public ownership requirement of 1/3, right? And that's most easily facilitated by the selling shareholders, the sponsors, selling their already existed shares, right? They got those shares when they incorporated. Now, so those transactions, the funds will go not to the REIT company, but to the sponsors. The question pertains to a primary offering, the way I understand it. So yes, that is an allowable use of proceeds for the REIT IPO, especially as it relates to a REIT property mortgage.
Okay, thank you. Another question from Mark. How can blockchain transform the real estate REIT? What do you think of the future growth of a global REIT as assets that are blockchain based?
Blockchain, in terms of creating a token, I would say, is a potential opportunity for the real estate. No? As an application of the technology, it can be transformative if you look at, instead of us relying on a centralized register, the Land Registration Authority or the Registry of Deeds, right, to determine who is the rightful owner, blockchain can actually be used, subject to amendment of the law, to ensure that at any given time you're able to validate. Remember, imagine rather if you are transacting with someone you do not know, but the technology behind your transaction is founded on a decentralized blockchain, right? It's everyone validating that the person is who he represents himself to be, and that he really is the owner, and that would be by way of the blockchain technology. Can you imagine? That's a very powerful tool. Real time, you can validate. You don't have to go to a central registry anymore, right? That's on the technology. But on the part of probably you can even tokenize the real estate. Now, in the same concept that I mentioned earlier, in other markets, no, expensive works of art, they can now democratize and sell to the public via tokens, right? And that's also a potential investment opportunity when you look at expensive real property that you feel public shareholders may want to take interest in. And that, I think, is the way of the future. It's already here. I don't think we can deny that crypto assets are already here. Whether it will be a fiat currency, I don't think the BSP or the Central Monetary Authority will say, that's fiat currency, right? I think we're a long way from that policy perspective. But in the investment space, it's a security. It can be a security if it's a tokenized asset.
Thank you. Okay, there's another question from Edwin. Are foreigners allowed to own REIT shares?
Yes, they are allowed. REIT to the extent of 40%, subject to nationality restrictions.
Yes, and that's very clear in the rule, in the law. Yes, let's move on to the next question. Cecil, what's the difference between the REIT law and the securitization law? Aren't there overlaps in both laws?
Very good question. We actually were the authors of the Securitization Act of 2004. And what we intended to do with the Securitization Act was coming off the heels of the SPAV law. The SPAV law enacted in 2002. 2 years later, we came up with the securitization law, right? We adopted a couple of the incentives in the securitization law and embedded them within the REIT law, okay? Are there overlaps? There are no overlaps because the securitization law presupposes what's called an asset-backed security or a mortgage-backed security, MBS or ABS. A REIT is not, theoretically, technically, it is not a derivative, right? Because I am issuing underlying common shares, right? A PDR, for example, is a derivative, a depository receipt. A REIT is not a derivative, right? Securitization pertains to the fact that you are going to issue derivatives. Normally, they are backed by an underlying asset or a mortgage, and you would like to offer that to the public. No? A REIT is more bespoke and more specific to the structure of a real estate, income-producing real estate, and you corporatize that so that the investing public via shareholders will be able to participate in the dividend potential of that company. I hope that clarifies the question.
Thank you for that. The next question from Jojo is there a lock-in period? Can you trade REIT shares? What are the taxes involved?
Good question. Lock-in period will always be a function of what level of ownership you have, okay? We require the lock-up for 10% or more shareholders. And these are normally the sponsors, right? Remember, when you do an IPO, outside of a REIT, right now you have to offer 20% if it's not a REIT, if you do an IPO today. But if it's a REIT, you have to offer 1/3, right? So that's 33.33%. And the 33% will be widely dispersed. There will be no shareholder who will have 10%, right? But the lock-up period of 10% will apply for the next 6 months, just to make sure that the sponsors do not dump their shares. And in the end, the public who subscribe realize that they don't have anymore the strategic vision of the founder. The value here is the management. That's the vision of the founder. So during the lock-in period, there is an escrow mechanism. You cannot trade during the lock-up period if you are the sponsors. Okay. A variation of the lock-up period is, and this is for those who are involved in REIT offerings already, if you get your shares 6 months prior to the IPO, okay, and the shares were obtained at a price lower than IPO price, okay, how do you get that? Normally, by a legal right of conversion. If I have, let's say, convertible loans, and I opt to convert to common, then at the conversion price definitely will be lower than IPO price, okay? If I have preferred shares, I invested via preps, converted to common just in time for the IPO, I'm pretty sure the conversion, the strike price will be lower than the IPO price. Now, will you be locked up? The answer is yes, generally, for 1 year. Because, you got the IPO, you got the shares lower than IPO price. And most likely, by design, right? Most likely by design. However, we have relaxed those rules, and on a case-to-case basis, we do allow for the converted shares to be included within the IPO shares, right, by way of secondary offering. Okay, so I repeat, generally, it's just a 6-month period. It could be 1 year only if you got the shares via an issuance 6 months prior to the IPO, and the price of those subscriptions or conversion, and what I see in the market right now is more out of conversion, is lower than IPO price, in which case your lock-up period is 1 year. But an exception to the exception, because a REIT offering is to comply with MPO requirements, minimum public ownership requirement, then we will allow on a case-to-case basis, that you'll be able to participate as well during the public offering. And then after the IPO, you will again be locked up. Okay, so that's the lockup mechanism in the exchange right now.
Thank you. Oh, this is how can lawyers participate in the REIT mania that we are seeing today, whether as an investor or as a law practitioner? Any suggested approaches to tap this opportunity?
I believe that there's a very limited group of practitioners that have seen the benefits of this REIT industry. It's a new asset class, and this will only grow in the future, right? They demand good legal services, whether you are looking at the issuer, right? Whether you are looking at the property fund manager, right? Or whether you're looking at underwriters that really need legal advice. Why? Because there's a lot of risk when you look at real estate, no? It could be that you would tap more than one law firms when you look at opinions that all laws have been complied with, especially when there are litigations involved over the real property, right? This will have to be required to be disclosed by fiat of law, and lawyers can participate. Right? Law firms, we see that there are select law firms who participate, and that breaks my heart because I think this is a very attractive legal practice, and it's not bespoke to a particular few. No, the very concept of a REIT is corporate law mixed with securities law mixed with finance, right? And the regulations on tax regulations, we saw that this is centrally a tax preferred or tax favorable vehicle at the end of the day. Not pass through, but there's preferential tax. Can you imagine you can deduct dividends by way of expenses and come up with almost zero taxable income, right? So lawyers do interface with issuers, underwriters, investors. Yes. When there are investors who come to the REIT before it does an IPO, they embed within the agreement a lot of these options, conversion feature. When you do an exit, then my client should be entitled to the following, right? It's a liquidity event, as they call it. This requires legal crafting. And I think this is where the lawyers who are exposed to these transactions or to the nuances of a REIT can actually participate and add value to the client. So as an investor, that's on the side of legal practice. As an investor, I think the numbers speak for themselves. If you are still unconvinced, you have seen the returns. I'm not saying those are guaranteed. What I'm saying is the law requires that there be a 90% minimum dividend declaration for all these income-producing assets, right? I don't think you can find that anywhere else because, as we know in corporate law, unless and until the board declares dividends, there are no dividends to talk about, right? Na-declare na nga, minsan wini-withdraw pa. As I saw in a lot of cases last year, already payment date in 1 week, because of COVID, they withdrew. Sorry, we cannot pay. In the case of a REIT, they are required by law. Why? Because there's income flow, subject to the volatilities of business, of course. You are not expected to give 10% dividend yield. If the expectation is 2% year on, year out, then you will be able to give that. So I think when we are most productive in our legal practice, it's best we think about long-term financial independence as well. And we in PSE would be more than happy to talk to you as a group or to your law firm, simply because there's a lot of money being left on the table. Sayang. Let's not leave money on the table. We can participate in the REIT mania and the returns.
Okay, I have a few questions here. Okay, there is a question here before I give those with me. Will we ever see cryptocurrencies tokens traded in the PSE? This is from Sherdil.
Hi, Sherdil. We're looking at this potential, I would say, offering, no? But the core issue is, will these be classified as securities? Because the exchange, being an exchange, can only offer securities, right? If these are not classified as securities in the sense that they are utility tokens, meaning you use them, then they cannot be traded in the PSE. But there's a caveat, no? I think we have been we have been in touch with a couple of cryptocurrency exchanges, both domestic as well as the big international exchanges. And the way forward for this one really is to see where we can intersect the concept of trading cryptocurrencies with the concept of trading any other security. There's price discovery, there's regulations against wash sales, there's regulations against fraud, right? Really, in cryptocurrency, you don't know if it's just the left hand, if it's just related parties, right? They're just hyping the price. So I think this will be dependent on whether this will be defined as securities. I hope we can offer this, and this is just my personal vision, simply because it's already here, right? In Singapore, they adopt what's called the regulatory sandbox approach. You will be allowed, even if the regulations are not clear, to conduct your business, as long as the regulator will say, I want to learn from you. I will allow you to do business. But then be ready to comply with regulations after a period of, let's say, 1 year. That's a regulatory sandbox approach. In the Philippines, that's my vision. I hope we can adopt that vision so that we can learn as we go, as we speak, right? We learn as we go. And that's the only way for us to learn how best we can grow the market.
Okay, there's so many questions. Another from Joseph. How do you see the future of PDAX as it builds the cryptocurrency ecosystem in the Philippines?
So PDAX has not been licensed yet as an exchange under Republic Act 8799. PDAX, however, has a VASP license from the central bank. I understand they also have the EMI license, electronic money issuer license, as well as remittance and transfer company license. Can you imagine 3 licenses from the BSP? No. If you look at the cryptocurrency ecosystem, it's really a question of adoption. When people buy, and it not necessarily Bitcoins, that's so expensive, right? Whether it's Ethereum or let's say Dogecoins or any other crypto out there, why are you buying it? Ask yourself, why are you buying it? Well, it's really because you hope it will go up, right? But that hope may fizzle out because the dynamics or the underlying essentials, what is really the intrinsic value of the cryptocurrency? Okay, the answer is it's an algorithm that prices a cryptocurrency when it does an initial coin offering. In the case of an IPO of a REIT corporation, there is no such algorithm. There is a value of the real estate, the income stream, and that is used by the valuation companies when they build the book for purposes of a potential pricing. So meron talagang halaga. In the case of cryptocurrencies, it's an algorithm that prices it, no? Both in the ICO as well as in the secondary market, demand and supply feature. So I feel it is here. Does not mean that we should close our eyes to it. Cryptocurrency is here. Digital banks are already here, right? You have now digital payment systems, cashless transactions. So it's a natural evolution of markets, and we have to embrace this. That's my view. No, we have to embrace this, and I think the way to embrace it is to regulate it. No, but too much regulation is also bad. Let's not kill the industry. Let's just do a soft touch regulation to the extent we can.
Oh, thank you. There is a question here. How are proceeds of the sale of REIT assets treated if there is a gain?
Oh, so that will be subject to if it's an ordinary income, then it's an ordinary income tax that will, because it's being used in the trader business of, let's say, the sponsor or the promoter, right? I don't think, if it's a capital asset, then it will be subject to the capital gains tax, 6% presumed capital gains, right? But on the part of the promoter, is that the question? Yes. The part of the promoter.
Now, let us say on the part of the investor, he learns.
Oh.
He learns that, for example, that the REIT sold a capital asset, a real estate, for an amount of 60 million. And is it treated as distributable income? The proceeds of a real property that was part of the REIT that was sold by the REIT.
Yes, that will have to be treated as part of distributable income, which will then form part of the potential dividend cash dividends to be distributed to the investor. So when the REIT does that, I just like to highlight, it should not be viewed as exiting the REIT business. It could be that it is actually diversifying. It's selling suboptimal asset. Okay, it's seen better days. It's selling it now, and the proceeds it will now buy for a better income-producing asset. So the gains will have to be factored in because that's technically going to be part of your retained earnings, really, that could, subject to positive retained earnings, you can distribute cash dividends for the investors.
I think a follow-up question on that, Attorney Refran, would be, what if they held on to the proceeds for now and plan to use the proceeds of the sale 2 years down the road? 2 years down the road.
Good question.
Will that be part of the distribution for this year? Or can the REIT effectively hold on to the funds for the time being?
In short, probably they're looking at appropriating the retained earnings. They will create, they will agree that we will appropriate retained earnings. The simple answer is it should be part of distributable income. An appropriation of retained earnings will be viewed, will not be a tool that's available for purposes of not complying with the 90% minimum for distributable income.
Okay. So
because it's supposed to be passive income, Attorney Tranquil. Expectation is for them to get, not to park it in the future. So if you want a capital base, then that could be fundraising via other means. Maybe the REIT can fundraise. Maybe the REIT can issue new securities. Then it has a cash pool.
So the mindset of the investor should be, they should have peace of mind and don't worry that they are entitled to their distributive income, right?
As a legal right, Attorney Tranquil, as a legal right.
Yes.
Can you imagine? I've never seen a law that mandates 90% distributable income to be declared by way of dividend. How good can it get, right? So that's the story of an REIT.
Yes. Do we have any more questions there, Anvic? Okay, so again, just a few more. Will we ever see a Bitcoin ETF listed on PSE? From Rafael.
Very good question, because an exchange-traded fund, you probably know, already have an ETF. An ETF is a derivative, and the current ETF that we have right now tracks the underlying benchmark PSEI. Now, if you're saying we will have an ETF, maybe tracking the performance of Bitcoin, there has to be a sponsor issuer. This will be a corporation that would hold title to the underlying Bitcoins, and then they can float that in the market. No, we don't have regulations yet for that, but that is an opportunity as well when you look at cryptocurrencies. No? Because I think an ETF is closer to home as a security than the Bitcoin. So you are actually democratizing ownership of a Bitcoin. Very expensive, and as well, very finite. No, if you look at the sourcing, there's only so many Bitcoins that can be issued. So ETFs would allow for democratization and ownership of that investment.
Okay, I think for a last question, this will be very interesting. What is a synthetic investment product? This is a bit difficult. What is a synthetic investment product?
So it's a synthetic investment product, meaning instead of you holding on to the real assets, no, you're holding on, let's say, to securities over which you're trying to comply, for example, with the requirements under the law in terms of ownership of real assets. Now, there are synthetic instruments other than the real assets. Now, it could be bonds, could be derivatives, could be credit default swaps, for example. Remember in the 2008 crisis, there was a lot of flack received by credit default swaps, CDS, which are essentially insurance products. No? If the market goes against you, I can tap on the credit default swap. So the limitation, I think the limitation on synthetic products is, I think, at 5%. No? The limitation there is to make sure that you are not engaged in too much risk-taking, right? Interest rate swaps and all of these. I don't think that is something that an investor in REIT is looking forward to, because he is looking for the stability, right? You're happy that you can pay off your household expenses, or maybe have some leisure expenses as well, leisure money, because of your investments in REIT. Plus, the kicker is capital gains, right? In the life of the REIT, there will always be assets. And you've seen, for example, that's how the REIT will survive. And the best is yet to come. We have not yet seen the bigger REITs. As I said, SM, not yet there, right? And there's a lot more REITs. So very exciting for us, whether as investors or law practitioners. And I hope we continue this dialogue, Attorney Tranquil,
Yes.
whether
very
even
much.
outside of this discussion.
Salamat, Attorney Refran. And I think the listeners, our viewers, were very glad. We learned a lot from your comprehensive presentation. Thank you very much for your time, and we look forward to another session with you.
Maraming salamat to everyone
Maraming
as well.
salamat
And
po sa-
to Alay, salamat. And to you,
Salamat.
Attorney Tranquil. Thank you.
Salamat po.